some of the problem, you've got all of this noise going through your head. A lot of the problems, it's going to be easy for you to forget about those things that can cause you to be unprofitable and cause you to be inconsistent. And in my case, that's what happened this morning. Things started happening. The dogs were barking, and usually when they're barking uncontrollably, that means somebody's coming in the yard or somebody's walked up to my yard. And then my doorbell rang, and I'm like, what's going on? Because normally nobody rings my front door. If people I know are coming, they come to my side door and just knock because they know, I'm live. But so all of that kind of threw me off. And the reason why it messed me up is because I didn't put my stop in. I forgot about putting my stop in. And risk management is one of those things that, you have to stay on top of. And stop losses is a big part of risk management. Now, there's some traders that
Twitter
just,
at the high of the day now, 1503.
stop losses to them are just, you just don't put hard stops in. We're going to talk about that myth here in a little bit. But for new traders, for traders who are trying to grow their account and is trying to make sure that you limit your losses, you're going to have a hard stop in. There's really no way around it. If you ignore stop losses, you're not going to have a path to becoming a consistently profitable trader. It's going to be no way you get there. Now, over the past couple of weeks, I've had, several traders that, have called me, emailed me, or whatever, and told me that they broken the rule. They didn't follow their stop. And they ended up losing their money, or they blew their account. And I actually wrote a blog about it. And, because it's one of those things that just really, really needs to be respected, especially when you're a new trader. It's like I said, a lot of what I teach may be disregarded by a lot of the other education communities because what they want to sell you is this big dream. But in reality, in order to get to that big dream, you're going to have to learn how to navigate through the small stuff. And nobody talks to you or teaches you or explains to you about how to navigate small things and focus on the things that really matter. It's going to be very difficult for you to get to be consistent. And using hard stops is one of those things. And that's why I like to use them, and I like to demonstrate me using them, every day in chat. So what is a stop order? It's an order. A stop order is an order placed with your broker to buy or sell once the stock reaches a certain price. So you have to set your price in, whatever price you want to stop out at, and you set that in your platform, and you forget about it. The main thing is you set it and forget it. And we're going to look at that here in a minute. Okay, a stop loss order is designed to limit a trader's loss on a trade they're in. Setting a stop loss order for 20 cents below or above the price at which or short of the stop, it's going to limit your loss to 20 cents per share. So if you're in 200 shares and you've got your loss limited to 20 cents per share, then the most you're going to lose is 40 cents. So, for example, let's say you purchase CAT at $80.50 per share. Right after you buy the stock, you enter a stop loss for $80.30. That means if the stock falls below $80.30, your shares will be sold at the market price. And what it's doing is protecting you. If the most you're willing to lose on a trade is going to be 80-30, then 20 cents, then you got to set a 20-cent stop. And if the most you're going to lose is say $40, let's say your max loss per trade is going to be $100, you can stand to lose $100 for every trade you take. That's your max loss. So if you get in at 80.50, then 79.50 has to be your max loss stop. Now, I'm not saying that you stay in the stock until it hits your max loss. That's there just to protect you in case something happens. Let's say your internet goes out and you can't get it back. And by the time you get logged onto your phone, the stock has run away from you. These hard stops are there to protect you in case something crazy happens. It's not there for you just to let the trade work. There still has to be technical stops, common sense stops. But this is just to protect you in case you go, things go haywire. Which it would have protected me this morning because it broke through a technical level that I had kind of based the trade off of. And we'll take a look at that here. Let's bring this chart over.
MYL, Mylan.
All right, here's the
Now
chart.
the lows of the day, 40.32 down.
Here's where I got
$1.40
in.
that complete
I got
response
back
letter
in.
from the FDA.
And this was kind of a chase, kind of a fear of missing out because we lost. I was waiting to lose the VWAP. We had this big candle print. Now,
That's Michael
I
Yankee
know
Lima.
I'm supposed to wait for this to come back and test and fail VWAP in order for me to get in. I know this. But with everything going on, I had to get in here. I didn't want to wait. So instead of me waiting like I'm supposed to, I got in. And then, this candle ran up, but then this candle was selling off. And this is when I got distracted. And so I was thinking, okay, this is going to start working. By the time I get back, I should be able to cover. I had no idea that this was going to turn around and go the other way. And so when I came back, I didn't have a hard stop in that should have been, right in here somewhere. I ended up losing twice as much as I wanted to lose. All because I didn't put a hard stop in and I got distracted. And that took the nice profit I made on this trade. It just kind of took it back. Took it all back. And this is what we hate. We hate to see every day. And this is why I advocate using hard stops. Whether people believe in them or not, I advocate using these hard stops. All right, so again, I stress that I firmly believe that when you're starting out in day trading, using a hard stop loss is a must. You've got to know where your stop points are. Where your technical level means where the trade is just not going to work. If you lose that level, you know for a fact that trade isn't going to work. And you need to get out and wait to see if it sets back up. But you have to have some type of loss. Before entering a trade, you've got to know where you're going to get out if it goes against you. You got to know this. So, for example, if you base your stop off of a technical level, such as VWAP or a moving average or a daily level, if you lose that level, if the price action claims that level, then you need to get out. You've got to respect it. Because if you don't, it will hurt you in the long run. If a new trader has a max loss stop to protect their account, and the price quickly runs away from you, like if you get in and you have a max loss stop that will protect you against a $50 loss, and you get in 100 shares, and all of a sudden the stock runs away from you 20-30 cents, you still need to respect that max loss stop. You got to respect it. And like I said, I haven't been respecting it as much as I should have. And that's something that I'm going to be working on here in the next couple of days. All right, a new trader, just like an experienced trader, has to be disciplined about this. And we experienced traders, we make the same mistakes. Everybody you see that maybe runs their own community, or that may be a moderator, they have these same issues. They do the same thing. Sometimes they won't stick to their stop, and they'll keep adding, and they'll try to keep averaging up, and then they end up having to take a bigger loss. So we go through these things, and when we catch ourselves, then we realize we need to come back, reset, and get back to the basics.
Crude futures settle at $49.51 a barrel. That's up at 14, 2.6.
So one reason I like this type of strategy for new traders is because by forcing the trader to place a stop loss after every time they enter a trade, you're going to start building discipline and learning to treat losses just like gains. You become emotionally detached from the trade. And that's what you want to do. You can't eliminate emotion. If you try to eliminate emotion, you're fighting human nature. And when you fight human nature, you're going to lose. So what you're doing is you're channeling it. You're taking the emotion away from the trade, and you're putting it on somewhere else. Your emotions will be focused somewhere else, not on the trade. So by physically placing a stop, you're not going to run the risk of holding a long position. You're not going to be sitting here thinking, what if this thing runs away from me and I blow my account up? These thoughts are not going to be there because you have something to protect you. And oftentimes a new trader doesn't have the skill to read price action well and really determine quickly whether it's ideal to stick with their initial stop or maybe it's a fake. Now, I don't know if you were in chat a couple weeks ago, you saw me pull my hard stop because I noticed what I felt was going on, that we were catching a run up to take out stop losses around VWAP, and then it was going to work. So I'll quickly pull my max loss stop, let it test VWAP, and then the trade worked. DDS. But the only reason I was able to do that was because I felt comfortable reading the price action, and I knew that if it kept going against me, I kept seeing the wrong thing in level 2 and time and sales, I would just get out. I would still be pretty close to my max loss stop, but it wasn't because I was being stubborn. It was because of what I was seeing. So it also will help you prevent you from holding your position too long. And you'll use the discretion. You won't be doing it because of fear, because you don't want to lose. It's like, there's no way I'm going to lose on this trade, so I'm just going to hold it until it works. And then once it works, I'm going to be good. That's not, the right way to do it. That's not what you want to do. All traders really need to learn how to use proper stop loss placement techniques. And really what you do is going to be, it has to be comfortable to you. what you feel comfortable with. But no matter what, you have to have a max loss per trade. You've got to set that up, and you've got to say, okay, this is the most money that I'm going to allow myself to lose on any trade I take. Because if you have an unlimited loss, if you only have $1,500 in your account and you have DDS, you don't have an unlimited loss amount. Because if you lose $1,000, you're through. You're pretty much done. If you lose $500, you're halfway to being done. So that's not what you want to do. You want to protect yourself. And you can see I've had a bad Monday. I had a bad Tuesday, where Monday I lost over $200. Tuesday I made $1.47, and today I'm down over $100. So even though I haven't done well these last couple of days, me sticking to my stops, and even when it got away from me today, had I had a stop loss in, I wouldn't be down $100. I'll be even better. But because I knew I needed to stop out when I got back, because I had lost the technical level and I knew I needed to stop out, I did it. I went ahead and took it off. But it protected me. So now I can come in tomorrow. I'm still up on the month. I still, doing real good for the month. I still have 2 days left in the week in order to right the ship. So, and that's because I kind of stuck to my stops all week. I made sure that I managed my risk. But using those stop loss techniques really protect you and keep you from messing yourself up. All right, for this reason, you've got to have an effective strategy. And you've got to be very clear where your stops are, where you're going to place a limit to how much you lose. I know a lot of people ask me every day, what's your stop? What's your stop? What's your stop? I can tell you what my stop is, but you have to base your stop on what you can lose. How much risk can you stand? That's where you need to put your stop. That's what you need to think about at night when you're reviewing your trades. When you're going over everything, think about where do I want to place my stop? Is this and when you do that, you're gonna have a better chance of being successful. And the way I see it, if you set a stop loss and you stick to it, that's a win, just like as if you stuck to your profit targets. It's a win when you stick to your guns and you stick to your rules and you stick to your trade plan. So all traders, they have to know how to use proper stop loss techniques. There's no way around it. So since our capital is our lifeline. We can't make money paper trading. Yeah, we can paper trade once we blow up our account, but we can't make money doing it. So when we start trading and we start using our own capital, we have to protect it. And the best way to do that is knowing where our profit targets are going to be and where our stop loss is going to be getting in. Because the worst thing you can do is take a trade off early and you leave a whole point on the table. If you take a trade and you get 50 cents of it, it's kind of hard to convince yourself that you got 50% of the move. Or you got the meat of the move. It's going to be hard to convince yourself you did that. So you're going to be pretty bummed. Okay, the best way to do this, well, I tell you, not only should the trading strategy provide you with an
Top Senate
entry
intelligence Democrat
with a
warner
higher
says Russia's
probability of
movements within
making
the United
money,
States should concern all
but it has to
Americans.
have strategic and specific points to limit losses. And I say strategic because not only do you have to have your max loss, the most that you can stand losing on a trade, but your stop has to be strategically placed. It has to be in a point where you're using some type of technical level to let you know whether your trade is still in play or not. It could be the VWAP, it could be the moving averages, it could be a daily level. Whatever the case is, you've got to have that strategic point to help you figure this out. And those stops should keep the losses from bad trades you have manageable, and it should be flexible enough to give your winning trades room to grow. And these are the critical skills that we teach in day trading courses, or better yet, if you have a mentor, they can work on a specific process for you. What you like to do, what looks good for you. Because what I do may not work for you. You may have to adapt what I do, or you may have to come up with your own process. But whatever the case is, you have to come up with a process. All right, now, here's a theory that a lot of people subscribe to, and I actually believe it. I happen to believe in this theory because, when you enter a stop loss into your platform, the order is transparent. It goes out there for people to see. So whoever can see the depth of level 2 and all of the orders out there, they can see it. In a game that some market makers play, is to take out the stops. When the stock is forced low or high enough to trigger a large cluster of stop orders, it's usually around whole numbers or half dollar marks or well-known support and resistance levels, which are the VWAP, the moving averages that day traders use, the daily levels, which are actual supply zones. These are places that they know we like to set our stops and we base our trades on. So let's look at, let me pop this chart out again. We can use this same chart here. If I can get it over there. All right, so you can see right here, if we were using the 20 as our stop, you can see we've got wicks here, 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 and here trying to break over the 20. And the whole time I was waiting for a clear rejection of this 20 moving average. We got it in one candle, but here's where people were getting stopped out. Here, they got stopped out here because they're using this moving average, as their stop for the short. Because just like me, they were looking at the rejection of the 9. They get in here, and the 9 moving average is their stop. They get stopped out. They probably got back in, got stopped out again. But these wicks are just the price action going up and then pulling back. They go up, they're taking out people's stop losses that were basing their trade on this 20 moving average. It does the same for the VWAP. It does the same for just about any other technical level. That's kind of what happens.
CFG,
And
Citizens
some people say no, it doesn't happen. Some people say it does. I'm telling you, I see it. We just looked at it. We see it every day.
Volume. That's Charlie
when you have a big wick run up and tap multiple moving averages, multiple places of potential resistance or support, and then the stock comes back and starts to trade the way you want it to, it just took out a bunch of stop losses. So, and after the stop takes them out,
Current
then
and
it
former
reverses and it goes and it
Citizens
does
Financial
what we thought it was going to do to start with. This happens
branch
to a lot of us.
employees said they
I
faked
mean,
information about customers
I
attending
can't say anything
hazard
else. It just
citizen
happens
checkup
to us,
program, according to the
and
Wall
we
Street
see it
Journal.
every day. So that's why I always suggest
Foxtrot
that you do
Golf.
not put your hard stops close to key technical levels. If you want to get in 100 shares and you put in a 50% hard stop because the most you want to lose is $50.
That was
And when you put that,
earlier, actually,
you look
on
at the
CFG.
chart and 50 cents is right on the VWAP, then I would suggest either not taking the trade or taking the trade with smaller size or adjusting your hard stop to where you may have to lose a little bit more, because you always want to give room for these technical levels to get tested. That's my take on it. Now, other people may teach other things, they may believe in other things, but from what I see every day in the market, I made that distinction, and by me not having my stop so close to these levels, it actually keeps me from getting stopped out prematurely. I mean, is it going to happen? Yeah. No matter what. You can get a stock to run up 30 cents and then come back. I mean, it happens. But the main thing is you want to be aware of it and you want to protect yourself from it as best you can. So always give some offset so that you're not caught in that game. All right. Let me just demonstrate this one more time. So here's a deal here. I got in on this candle right below the VWAP. So I'm going to set my stop at least 10 cents above the VWAP here. Because if I had my stop on, I would have got taken out on this candle here. See the little wick that ran up above VWAP? If I was using VWAP as my stop, I would have closed out my position and missed the winning trade. So that's why I always say I want to have it far enough above VWAP, but then I'm not going to stop out unless we get a close above VWAP like this, where we get a close above it. I let this candle open. We sold off, but then we got bought right back up, and it was time to get out. That would be time for me to get out. So I'm going to use these levels. I'm going to give it a chance to test it and continue to fail. But you have to have your max loss stop far enough away so that you can test this level and you have a little risk of getting stopped out. All right. Now, the biggest problem I see with stop losses is that you give up control of your sell order to the computer. But that's the control that you want to give up. You still have the ability to manage your trade. You're just giving up this critical component that's designed to protect you. You want to give up that critical component
CFG Citizens
to the computer because
Financial now seeing sweep.
in a volatile market, yeah, it can cost you money.
25 put on Charlie
But
Foxtrot
that's
Golf.
where knowing the swing and the rhythm of your stock comes into play. If you get in a stock and you give it a 50-cent stop, and then you see every 5-minute candle is swinging $1, then expect to get stopped out. Because you're putting in an order with half of what a normal stock will swing. So you need to either size in to give yourself enough room, or don't take the trade at all because you don't have the risk tolerance to be in that trade. Same way with the spread. You got to have the risk tolerance to be able to deal with the spread. And a lot of times it's reducing your share size is the easiest way to deal with it. Now, but as a new trader, you've got to learn discipline and you got to trust your stops. So setting hard stops is going to be a long way to doing that. Is being disciplined. And not only setting stop losses, but setting profit targets. And you've seen me this month set my profit targets, set limit orders for my profit targets. Because I had a problem of not sticking to them. I had a problem of greed, saying that, okay, here's my target, but I think we're going to blow through it and I can get an extra 10 cents. But guess what? It came down and stopped out and missed my order by like 5 cents or 2 cents. And then I end up getting stopped out, losing $100. Makes absolutely no sense for that to happen. So we want to make sure we're able to set not only profit stops, not only, hard stops and stop losses, but we need to have profit stops in place too. One of the largest advantages we have as day traders is the control that we actually have over our trading. We're the ones that can control it. But for the sake of education and progression, sometimes we got to give up that control. And one of those critical things is stop losses. We want to make sure that we're comfortable giving that up. All right, so the last thing I want to share with you are the different types of stop losses. Now, you can just put in a regular market stop. That's what I usually do. I put in a market stop, and what it does is it allows me, to set a price, and no matter what, if the stock is running up, when it reaches that price, it's going to trigger an order. Now, yeah, I can get 5 cent slippage. I could put in an order at $42.97 and it doesn't get filled until like $52.01. Or it gets filled if I'm in 500 shares and it takes 3 orders to fill me. It can start at $42.97 and finish at $43.03. But I'm out. I'm out of the trade. I don't have to worry about it. So that's the most simple order you can do, is a market stop order. Now, stop limit order is if you set a limit to where you want to stop out, it can blow past your limit and it won't stop you out. If I had a limit of $42.97 and the price action jumped it and ran to $43.05 and just kept running, if your limit order gets jumped, it's not going to trigger. So that's why I always use a market. Now you can use a trailing stop, and that's a kind of a stop order that lets you say, if your bid, let's say you set a stop loss, a trailing stop for 20 cents below the bid. So if the price action ever falls 20 cents below the bid price, then your stop loss would trigger. That's kind of what a trailing stop is. So the higher the bid price is, the higher your stop's going to be. See, the key difference between the traditional stop order and the trailing stop is that the trigger price and the stop order is always going to be the same. Whatever price you enter in, that's where it's going to be. So the trailing stop is going to move up and almost be a profit stop.
RH.
It's well, it is going to be a profit stop because it's going to protect your profits as you move up. Now, a range stop order is kind of like a bracket order. You put in a high stop price and then a low stop price. So once your stock hits the range you designate, it'll just go through as a market order. I don't use bracket orders or range orders. I don't think you can do that in SureTrader. I haven't really checked or tried, but I don't think you can. If somebody can do it or has done it in SureTrader, correct me if I'm wrong, but I don't think they have that option. My phone just took a dump. All right, so does anybody have any questions? Oh, okay, Justin said you can use it. So I haven't tried. I don't use them. So I couldn't tell you for sure. Yeah, they call them range orders. Let me see. I hadn't even looked at it before. Let me take a look. Yep, they do. I see it right here, range order. Yep, all I had to do was look at it and check. I could have told you. All right, yeah, but does anybody have any questions about why I feel you need to use stop orders or how I use stop orders? I know if you've seen me do it many times, you probably don't have any questions about it, but just in case. All right, guys. Well, great. I hope this helps you understand, why I use stop orders and why I'm so adamant about telling people to use them. I think they're important. I think they will save you and will help you through your learning process, especially if you're just starting. It's going to help you stay in the game long enough in order to make it. And that's all it is. It is AR. It is hard. And you see me, I struggle with it too sometimes. But you can see where it can save you. And it's the main reason why I'm able to make profit. Even though my win-loss ratio may be bad because the market is not really giving us the moves or the follow through. My win-loss ratio could be bad, but I'm making money because I'm stopped out. Yeah, Louise, I just looked at it. I just looked it up or tried to do it on the platform and I see it now. I'm kind of focused, so if it's not something I'm looking for, I don't look at it. Yeah, it's worth paying for the platform, that's for sure. No, I don't use stop orders to enter trades. I just use limit orders. And yeah, you can build a hotkey for your stop loss. You can build a hotkey that says You can automatically place your stop 50%, 50 cents, or 20 cents or 30 cents away from your entry. You can absolutely do that. You can make a hotkey for it. I just have